What's going on, everybody? Thank you so much for checking in. In this video, we're going to go over SPY, which is the S&P 500 ETF, and we're also going to go over some stocks that we're watching for the week ahead. These stocks include names like NVDA, Apple, AMD, Tesla, and Amazon. We're going to give you all the resistance and support points that you need for these stocks. That way you know exactly where to enter, where to take profits, and where to cut losses if you have to. So let's go ahead and get started by first talking about SPY, and we're going to do so on the daily candles, where we can see that last week markets continued their pullback and SPY closed just above its 50-day moving average. This 50-day moving average was tested 3 times between the months of April and May, and you can see that we held above it all 3 times, and it continued to send us higher into new highs for 2023. Now that we're back at this level, buyers are wondering if we're going to hold. Looking at the volume, we do see that volume is starting to decrease, and it's looking like buyers did not come in very strongly at that 50-day moving average compared to the selling volume that existed the previous day. Another important trend line that we broke back below this week was the yearly trend line we've been watching for the last few videos, and this was the trend line that we can see here, in which we got rejected at once, twice, and 3 times throughout this entire year, and it sent us down for months after. Now that we're trading below this trend line, buyers are going to need to regain control as fast as possible for them to regain the bullish trend. Now, before we talk about different levels, let's talk about some events that happened last week and some events that are happening this week that can influence where the market goes next. First, last week we got the newest CPI data, and it showed a 3.2% year-over-year increase. So inflation went up last month by 0.2%. This may not look like a big jump, but it takes us further away from the Federal Reserve's target 2% rate. Now, the Federal Reserve for the last 12 months or so has been raising rates in order to battle inflation and bring it down to 2%. So now that we have moved back from 3% to 3.2%, this could spell further rate hikes, and rate hikes are bad for the stock market. They hurt company bottom line and they hurt profits altogether, which is why the market typically reacts poorly to them. Now, apart from the CPI data, we also got the PPI data last week, which also showed an uptick on the producer index. So all in all, inflation reports last week did not come in line, and they came in above expectations, which is not good. Now, speaking of the Fed, the Federal Reserve will be releasing their FOMC meeting minutes this week, which is pretty much a recap of what happened during their last FOMC meeting. This typically gives investors further insight on what the Federal Reserve members are thinking. Typically, it's not really new information, but it does make the market nervous, so make sure you're on the lookout for that report this coming Wednesday. Last week, we also saw the University of Michigan release their preliminary consumer sentiment index, and it came in at 71.2. Now, the previous reading came in at 71.6. We are overall doing well on the consumer sentiment side compared to last year's of around 58. So overall, consumer sentiment is good, but there are multiple reports this week that will be coming out that will give us a further insight on how consumers are spending their money and how confident they are. First, there's going to be retail sales, which you can see retail sales has actually come below estimates over and over again. So although consumer sentiment is positive, people aren't spending their money in retail businesses. They're spending their money out in other places. So retail is hurting, and retail is at the front line of consumer spending. So this can give us an insight of how our economy is doing from the retailer and the consumer side. Apart from the retail sales report, we are also expecting company earnings from big box retailers like Walmart, Target, and Home Depot. Lots of eyes on Target because Target has had a lot of headwinds this past quarter, and people are expecting a big loss. Now, typically, retail earnings do not impact the market as severely as big tech earnings, but if there's a large miss across retailers, then we want to look out for weakness, because that means consumers aren't spending their money where they need to be spending their money. So now that we know what's going on the economic front of the market, let's talk about some charts and levels to trade for the week ahead. First, we're going to talk about SPY, and we already mentioned that SPY is back at its 50-day moving average, but now we're going to talk about some key levels. First of all, obviously last week we sold off and we have been selling off since the beginning of August. It all started with the Fitch downgrade of America's credit rating. Investors are not comfortable, but it's not severe just yet. You can see that this is a very slight pullback compared to the very strong rally we've had all year. Now that we're trading near the 442.20 level, that is a major support that we want to pay attention to. This is just below the gap fill, and if we break below that level, there's not much support. As you can see that when we rallied between July 10th and July 11th, this rally was nearly vertical and it did not create many supports. So if we do fall below this level, it could be a sharp decrease down to 436 to 437. And keep in mind that if we break below that level, it also means that we would have broken below the 50-day moving average, which would be the first break ever since we got back above it back in March. So the 50-day moving average is used by institutional buyers. These are guys on Wall Street with a lot of money. And they are looking at that 50-day moving average to either add or as a major support. So if we move below it and we don't recover back above it very quickly, then we are likely going to continue this sell-off to the downside, with this being the first price target. If you are bullish on the market, you obviously need us to stay above this level, and you need the market to move back above the 10 and 20-day moving averages. Now keep in mind, we are saying the market, but in this case we are focused on SPY, or the S&P 500 ETF. When there is bearish activity in the market, things typically move all together, especially in technology stocks, which is why we always like to look at SPY's movement to determine what other stocks could be doing this week. As you can see, all the stocks on our watch list ended red last week, and that's because SPY was moving lower, and within SPY, these large tech companies were taking everything with them. Now on the buying side, if buyers want to regain confidence, they need the market to move back above 451.70 for them to regain their footing. Above that level, the first upside price target is going to be anywhere between 454 to 455, but the true breakout is going to be at 459.55. which is around the highest point that we made all year long. Above that level, we have a very strong upside breakout, but it's not likely that we test this level this week unless there is a very strong positive event that takes us above it. So now that we know what the general market is trading like, let's talk about some individual names, and we're going to start with NVDA, which is actually one of the only tech stocks that has yet to report earnings. Now, NVIDIA moved below its 50-day moving average last week. To our surprise, we have been very bullish on NVIDIA, and unfortunately, it broke the supports and is now moving below that 50-day critical point. The last time NVIDIA traded below that level was last year going into this year, so between December and January, and after it broke above it, it had a full 7-month rally before pulling back. This pullback is considered strong, but it's not considered a reversal just yet. Here are some levels to watch for NVIDIA. First of all, before we get into these resistance and support points, if you are a buyer, obviously you need us above that 50-day moving average as soon as possible. Anywhere below that level, it is at risk of continuing its downfall towards the 100-day moving average. If you are looking at close levels or resistance and support points, the first support you have in place this week is going to be at 403.50. If it moves below that level, then a downside put or a short position is possible to a downside price target of around 396. Make sure you check back in again next week because we're going to talk about some further levels and supports. To the top side, of course, NVIDIA needs to move back above 420 to regain any kind of footing, but bulls are not going to have control again unless NVIDIA moves above 435.75. Above that point, that's bullish territory, and they can easily take NVIDIA back towards the 450s. Looking at NVIDIA's daily chart, if it moves back above 435.75, this places it back above the 50-day moving average and closer to recovery back above the 10 and 20. Now keep in mind, NVIDIA does report on August 23rd, and NVIDIA's last earnings actually boosted the entire market. So this could be the same thing happening once again. NVIDIA might be pulling back before it loads up for earnings, but we won't know until it reports earnings, and we will play it as it develops until then. The next stock on our watches is going to be Apple. America's beloved and favorite company fell below the $3 trillion market cap last week. after earnings, and it's unfortunately now trading right at its 100-day moving average. If you are a short-term trader, this could have given you opportunities to play the downside. If you are a long-term investor, this could be a great opportunity to pick up some shares. And if you are looking to day trade or swing trade the stock for the week ahead, these are some levels to watch. First of all, Apple right now is in bearish territory, or on the short-term chart, it's in bearish territory. On the long-term chart, it is very much still in bullish territory. But on the very short term, sellers are in control. Below 176.55, Apple does not have much support, and the next downside price target would be between 170 to 171. A put or a short position below this level can be very profitable with this downside price target, but make sure you give yourself enough time. To the top side, Apple will need to break back above 181.50 for it to start recovery into a bullish territory, and that places it back within this consolidation range. You can see that Apple spent a few days above 181.50 before it continued higher for the year. So if it can recover back into this consolidation, these buyers may be interested again, and they may take it towards the upside price target of around 183.50. Above that level, the second price target would be around 186.60. The next stock on our watch list is going to be AMD. Now, AMD has been a bit boring. It has moved, but it actually hasn't moved that much. And we noticed that because our chart didn't really change that much from last week. If you checked into our last week video, you know AMD was trading right around these levels. The only thing we changed was we took the support from 107 to around 105.50. If you are bearish on the stock, you need the stock to move below 105.50 for a downside continuation towards the critical 100 support. Below 100, it could be a very easy fall towards 93 to 95. Now, considering the fact that AMD has been quiet for the last few weeks, it could mean that AMD is preparing for a large move. We don't know if it's up or down just yet, but we do have some levels to work off. We've already covered the downside levels. Now to the top side, AMD is going to need to move above 120.80 in order for it to continue its upside move towards 125 to 126. Now, there is some positivity in AMD, and that's the fact that it has actually stayed fairly strong through the market pullback. Yes, it has pulled back this last week, but not as severely as other stocks. That could be a sign that buyers are not willing to let go of their positions. So if that is the case and the market does bounce, AMD could be one of the stronger names, and it could easily move back towards that 132 to 133 mark. We do not expect that to happen within this week. Make sure you check back in again next week to see the update on AMD. The next stock on our watch list is going to be Tesla. Just like Apple, one of the most beloved companies on the market is unfortunately going through a tough time. Tesla has moved back below its 10, 20, and 50-day moving averages, so sellers are definitely in control, but we do see an opportunity for buying coming in Tesla now that it has filled this gap towards 234, or at least almost filled this gap towards 234. In fact, we have picked up Tesla calls in our premium group, and if you are looking to get into our premium group or learn about it, make sure you check out the link in the description. But as far as Tesla's levels go, here are some levels to focus on. First of all, if you are bearish on Tesla, congratulations. It is currently in stronger bearish territory, but we are expecting a reversal above 238. The stock will first need to move above 250 in order for it to regain some kind of footing. Above 250 it's possible for it to move towards 264.80 as the next price target, but buyers won't be in full control again until Tesla moves back above 274, which would actually place it back above its 10, 20, and 50-day moving averages. Above 274, Tesla can easily move back towards 284.60 and even 300. We'll talk about some more levels next week. If you are looking for a further downside move on Tesla, you need it to stay below 252.50 and break below 238 for the next downside price target of around 230 to 231. Last but not least, the final stock on our watches is going to be Amazon, which is still holding pretty strongly on that earnings gap up, but buyers have given back some of that control, which is not really something we like to see, but it's not uncommon when the entire market is showing weakness. Now, Amazon is one of the final stocks that's actually still trading above its 10, 20, and 50-day moving averages, or final tech stocks rather. And here are some levels to focus on for Amazon. Now, before we get into these levels, we have to talk about the fact that Amazon is experiencing something called the power earnings gap. And that's when they report very strong earnings and they gap up on those earnings. Amazon's earnings expectations were extremely strong from analysts, and they still managed to meet them and beat them all. So that is a great sign for the company. Now, if you are bullish on Amazon, you're going to need it to stay above 136 in order for it to avoid selling off and beginning to fill this gap down. Below 136, there's not much support. We can argue that there's a support around 130, but the true support below 136 is going to be around 126.40. Now, don't get too excited and say that Amazon broke 136. It's time to turn fully bearish on it. That doesn't necessarily need to be the case. It can take weeks for it to fill this gap down. So make sure you're giving yourself enough time on any contracts that you're picking up below 136. But the true bearish level that it needs to move below is going to be 123.80. Below that level, bears are back in full control and they can take Amazon down to these price targets down here. But we don't expect that to happen this week. If you are bullish on Amazon, congratulations. It's currently in bullish territory and it needs to move back above 140.50 to retest the true breakout at 143.63. Where did we get that? That is simply the highest point that Amazon reached during its post-earnings gap up. Above 143.63, Amazon can move towards the next price target of around 146 to 147. So I hope you guys found this video helpful. Thank you so much for checking in. Don't forget to subscribe and like, and best of luck.